What the OSFI? Now, I know you're probably wondering who the hell OSFI is, and to be honest with you, it doesn't really matter. All you need to know is they are the banking regulators that regulate our financial institutions. And they've got some big changes coming to the world of Canadian mortgages. And spoiler alert, they're not making things any easier for your dream of buying a house. But don't click away just yet. Stick around. I'll be breaking down exactly what these new rules are, what they mean for you, and how we can move forward despite them. Plus, there's a twist about some shady lender favoritism you're definitely going to want to hear about. Welcome back, everyone. My name is Myles Nowik of the Nowik Mortgage Team, powered by Indie Mortgage, and today we're diving into the wonderful world of Canadian mortgage regulations. I know wonderful is a bit of a stretch, but these changes could have some huge impacts on your ability to buy a home in 2025. OSFI, our friendly neighborhood banking regulator, and the ones that brought in the mortgage stress test, are back at it with new rules that are designed to limit how much we can borrow relative to our incomes. And they did try this once before, and it really didn't exactly work out for them. Let's just say it was one of the reasons, and many reasons, why the government's Homebuyer incentive program bombed harder than me attempting to fix my own leaky sink. Here's the deal. OSFI is introducing something called a loan-to-income, or LTI Cap, limiting how much you can borrow based on your income. Sounds reasonable, right? Except this is not for individuals. This is being targeted towards our banks. Starting roughly in Q1 of 2025, each federally regulated financial institution will need to cap the operations of high LTI loans that they can issue. The LTI cap is going to be set at 4.5 times a borrower's income, but instead of applying it uniformly to every single borrower, each institution has unique limits on how many high loan-to-income ratio loans they can have on their portfolio. The idea is to limit excessive household leveraging while allowing institutions to maintain a competitive balance. But here's the catch. It doesn't directly apply to individual borrowers. This means if you're not part of the select group allowed to exceed the LTI limit, you could find yourself out of luck even as these interest rates start going down. And the reason for this is, as interest rates come down, we generally see a decrease to that mortgage stress test rate, which is either the benchmark rate or contract plus 2%. So as that decreases, normally you'd be able to qualify for more mortgage. However, with this new LTI cap of 4.5 times your income, really, you're going to be stuck qualifying for the same amount, if not less, than you qualify right now at these higher interest rates. Now, what I find even more interesting is banks get to choose which borrowers get to go beyond that limit, which basically opens up the door to something we all know and love, favoritism. I don't know if you could tell the sarcasm there. If you're a super preferred customer, you've got a high income, a fancy account manager, or who knows, maybe you just bring them really good cookies once a week, you might be able to get higher mortgage amounts while others get left behind. And that's a major problem, in my opinion. This means wealthier Canadians could end up having better access to mortgage financing than average people just because they're already wealthy. The LTI cap only applies to new uninsured mortgages and excludes insured loans and renewals, which is good news for our first-time homebuyers. But the cap also covers all other forms of borrowing, such as HELOCs, second mortgages, and it's regardless of whether it's an owner-occupied property or an investment. Essentially, OSFI is using this rule as a backstop, especially during periods of low interest rates, to avoid systematic risk from households taking on too much debt. And that brings us to the effects on first-time homebuyers. Though not directly affected by these rules unless they're putting 20% down, it could put added pressure on them. My big concern here is that this could create a lot of FOMO, or fear of missing out in the market, pushing people to buy that next home without thoroughly thinking it through, pushing people into bidding wars, and potentially pushing up the prices of a home. And with quarterly compliance reporting expected, the pressure on these banks to stay within these limits might even make more restrictions for your average borrowers. With stricter limits on borrowing, getting into the market or moving around in the market could become a lot harder for a lot of people. Those who could have qualified for that next home might now be stuck in their starter home for longer, meaning less availability for first-time homebuyers and increased demand on the rental market. But here's the kicker behind all of this. If people are stuck renting, demand on rental properties will increase, and you know exactly what that means. Higher rental rates. Suddenly everyone's fighting over a shrinking pool of available rentals, and when rental demand goes up, so does the temptation for corporate landlords to swoop in with their big pockets, buying more homes and turning them into rental properties, essentially pushing up home prices and limiting availability for home buyers. So you've got higher home prices, tougher borrowing rules, and higher rental costs. This is a perfect storm for keeping us in this long-standing cycle we've been in for so long and potentially creating inflationary pressure in the future. Now, here's where it all comes together. OSFI is genuinely trying to manage risk by preventing people from becoming over-leveraged, which is crucially important for the stability of our financial system as well as Canadians in general. However, these measures could unintentionally make it even harder for your average Canadian to build any form of wealth through home ownership. And as mentioned before, they tried to limit risk with these similar rules in the Homebuyer Incentive Program. While well-intended, that program faced significant challenges, largely because of restrictive rules like this, which limited borrowers and left many potential buyers unable to afford suitable properties through the program. And honestly, why are we trying so hard to regulate mortgages and real estate financing when the real killer for Canadians' bank accounts and credit scores is high-interest credit card debt and car loans? So what does this mean for you? It means that if you're thinking about buying a home in 2025, you're gonna need to be a little extra prepared. It means we could see a bigger divide between those who can buy a home and those who can't, a divide which I feel is already far too wide. It means first-time homebuyers are going to have to get creative or potentially face maybe even being priced out of the market that they want to buy in. And it means renters may see an increase in competition, which would only drive the cost of renting a property up. So what can you do? If you're planning to buy, start getting your finances in the best shape possible. Save aggressively, reduce your debts, and consider getting pre-approved or pre-qualified, and have a mortgage broker look at your application so they can explore all the different lender options that are available while showing you exactly what you're working with, so that if you can't necessarily get to where you want to be, you can build a path to get there. It's also worth having that conversation with family members about potentially gifted down payments, which can make a massive difference on getting into the market or not, with keeping in mind that if you go over 20%, you could fall under the rules and regulations with this new loan-to-income servicing ratio. There are always ways to navigate these challenges, and these aren't the first challenges we've ever seen, nor will they be the last. It's all about staying informed and being proactive as things roll out. If you found this video helpful or eye-opening, hit that like button and please consider subscribing to the channel. I'll be keeping a close eye on these changes and breaking down exactly what they mean for you as we move closer to 2025. Plus, leave a comment below. Do you think these changes are going to make things better or worse for home buyers in Canada? I want to hear your thoughts on this. Stay tuned for my next video, where I'll be sharing some creative ways to boost your chances of getting into the market, even if OSFI seems determined to make it more challenging for you. We'll catch you on the next one.